Following the steep falls in markets in August and September, there was a sharp recovery in October, with global equity markets up by close to 8% and the riskier parts of the fixed income markets, including high-yield bonds, emerging market debt and convertible bonds, all up by 3 to 4%. In contrast, yields on safe haven government bonds in the US and UK edged up, resulting in negative returns from this asset class in the month. With investors taking advantage of the much better valuations across markets after the sell-off and the immediate concerns about China abating, as well as the ECB clearly indicating that it's prepared to loosen policy even further in its December meeting, risk assets had their best month for some time. Even commodities, which had been at the epicenter of the sell-off, managed a modest, albeit unconvincing, recovery in October. The main news drivers were again from China and the world's major central banks. China's third quarter growth came in at 6.9%, a touch below the administration's target of 7%, and within a few days the People's Bank of China used this as the signal to loosen policy further, with its sixth interest rate reduction in the past year, bringing rates down by 0.25% to 4.35%. At the same time, it eased banks' reserve requirements, which in turn should inject additional liquidity into the economy. Together with already announced fiscal stimulus measures, these moves should help to support the economy during its inexorable slide to structurally slower growth. Indications from the Chinese leadership suggest that the growth target will be reduced again to around 6.5% next year. If this is to be achieved, it'll require continuation of the rebalancing of the economy towards services and consumption to compensate for the clear weakness in capital spending and manufacturing. In Europe, although the European Central Bank kept policy on hold at its October meeting, it surprised investors with a dovish statement from Draghi. He gave a clear signal that if data on the economy and inflation remain subdued, there is a very strong likelihood that they will loosen policy further at the December meeting. This could include a further cut in the policy rate, which is of course already negative, an extension of the QE program, both in terms of duration and range of assets purchased. Asset prices across the euro area responded enthusiastically to this news and pushed bond yields ever lower. German government bonds now offer negative yields out to 6-year maturities. As well as the ECB, 3 other central banks in Europe, Switzerland, Sweden and Denmark, have negative policy interest rates, a completely unprecedented situation. With policy as extraordinarily loose as this, asset prices in Europe are likely to remain well supported for a considerable time ahead. While actions by the ECB are clearly important, all eyes are on the Fed in the US. Will they or won't they raise rates in December? Against a backdrop of mixed signals from the economy and core inflation remaining well below the Fed's target of 2%. The Fed kept policy on hold in October, as widely expected. Expectations for a rate rise this year have diminished considerably during the course of the past 12 months. However, Governor Yellen was much more hawkish in her comments this time around, leaving wide open the possibility of a rate hike at the December meeting. There's been no question that the Fed has been keen for some time to begin the process of policy normalization, but the global slowdown this year and strong deflationary forces, as well as mixed signals on the US economy and the labour market, have stayed the Fed's hand. But with the Fed seemingly less concerned now about the negative impact on the US of the global slowdown, and reasonably upbeat about consumer spending as real wages finally pick up, a rate rise is now much more likely in December. Indeed, the probability of a rise in December has increased materially with the release today of some strong payrolls numbers, and the market is now placing a 70% plus probability on a rise at the FOMC meeting on the 16th of December. If data releases remain broadly positive, we should expect to see the Fed continue to prepare markets for the first rate rise in almost 10 years. So far, markets have remained largely unperturbed about the Fed's more hawkish tone and the impact of such a rise, expecting any further rises to be very gradual. Indeed, the only assets to have been notably impacted by the more immediate prospect of policy tightening have been gold, trading back down towards the $1,100 level, US Treasuries, where yields have risen, especially at the shorter end of the curve, with yields there at their highest levels since the crisis began, and the dollar, which has continued to firm, notably against the euro. While the timing of the Fed's first rate rise preoccupies the markets, we have always argued that it's the extent of the tightening in this cycle, not the timing of the first move, that will be critical for markets over the next few years. On that score, we firmly believe that rates will move up only very gradually and will peak at levels well below those reached in previous cycles. As we know from the Fed statements, policy decisions will be data dependent, and given the fragility of the global economy, the continuing debt overhang, the sharp slowdown in growth in developing countries, and the powerful deflationary forces across the world, there's no question that the Fed will be extremely cautious. It's difficult to envisage rates above the 1 to 2% range in the course of the next 2 to 3 years, and at those levels, with most other big central banks maintaining loose policy, markets should continue with their upward progress. We're in a very long cycle, and the prospect of continuing subdued but sustainable recovery across the developed world, together with interest rates at historically low levels, provides a sound basis for growth in corporate earnings and strong support for markets. Having bounced so sharply from the big sell-off in August and September, markets might well pause now for a time, with the prospect of some nervousness as the Fed's December 16th decision approaches. Ahead of that, we will probably see the dollar remaining firm, bond yields edging higher, and markets generally reacting to every piece of data that might give guidance to the Fed's decision. But putting aside this short-term noise, and that's really what it is, we believe that markets are set to make modest upward progress next year, following a period of sideways trading and some quite heightened volatility really since the middle of 2014.